Okay, guys. So in the previous class, what was the topic that we were discussing? Can anyone tell me? Hello? Hello, can anyone
Sir,
hear me? What was the previous topic?
private equity, sir.
Yeah, in private equity
Yes,
only.
sir,
What was our
invest in
exact
private
topic that we
equity.
were discussing?
Yes, sir.
Yeah, tell me.
J curve
So what is the J curve?
indicates the cash flow of private equity, sir.
Okay. So basically the cash
Life
flows
cycle of
of
private
private equity
equity.
fund will be indicated in a J curve. Why? First, during the initial days, there will be outflow of money will be there, where we have to invest, where we have to find an opportunities. So money will keep on going out from the fund. Then after some sixth year or seventh year, then we will start realizing in terms of profits or maybe in terms of liquidations. We will start liquidating the investments. We'll start disposal of investments so that we will get cash into the fund. That's the reason. If you put all the cash flows in a graphical manner, we will get a J curve. That's what we discussed. And who is the limited partner? Who is the
General
limited
part.
partner?
Gen,
I'm asking who is the limited partner? Hello.
shareholder.
Who is the limited partner? Lakshman. Who are the limited partners, guys?
Yeah, hi bro.
Who is the limited partner?
Limited partner is
Who
a
have arranged the investment?
Let's Lakshman answer this question. Who is the limited partner? Who is the general partner?
limited partner will be for a certain period of time. He will be with the fund or company, and general partner is the fund owner. I mean, fund itself or general.
Is this what we discussed in the previous class about general partner and limited partner? Then what is LPA? What is an LPA? Guys, if you are preparing like this, definitely I cannot help you anything. Even if you want me to put some effort on your placement or something, I need some outcome from you, right? Basic questions. What is a limited partner, general partner? Limited partner is the persons who invest. General partner who manages the fund.
Yes, sir.
You're not even able to express this simple line. I'm talking what is the LPA. Not even single
Investors
guy is
and
able to explain limited partnership agreement. It's an agreement between the limited partners and general partners. Why not even able to express this simple line? Are you guys really watching attending the classes or are you just waiting for the placements? If you're really waiting for the placements, then let's stop the classes. Directly we can provide the placement assistance. If you want me to treat like that,
no, sir.
maybe after getting placement, if you can get a problems from the employment, like they may expect some output from you, the subject knowledge. At that time, if you can, if you lose the job, I won't be responsible. Do you want me to treat like that? From last 45 days, we are discussing all these concepts, right? I ask you from the day one itself, try to revise and try to learn whatever the concepts that we have discussed in the day by day. Then and there itself, we have to clarify the doubts and we have to complete the syllabus. In that way, you will be able to cope up with the content. Why? Because every day, some new subject and new concepts will be keep on adding into your bucket, right?
Yes, sir.
Ultimately, on 40th day, 45th day, it will become very heavy. So we're almost close to the concepts. We're about to close the entire batch. Still not even able to get answers from you. This is perfectly not the right way, guys. You have to think about it. Seriously, I can't help you if you're not focusing and if you're not putting any efforts. Okay. Okay, let me do my part. So we were discussing the private equity part. So we understood about what is the limited partner, what is general partner, how the investments, how the cash flow is moving from limited partners to the fund and fund to the investments. And we have seen how the investments will be classified as a portfolios and what are the exit strategies we have for the private equity. All these things we discussed. And also we understood the life cycle of private equity from launching to when we take a commitments, and also discussed about commitments. We'll take some commitments from the persons, right?
Yes, sir.
So that's how we discussed about the commitments, right? Then let's talk about the strategies, private equity strategies. Okay.
Okay, sir.
So in the private equity is for the we have different strategies. Normally for the investment ideas, as a private equity, the role is where they will invest into the privately held companies, and maybe even in sometimes they will invest in public companies also. But majorly they'll focus on the private companies. So what they will do, they will identify the private companies. They'll aim to improve their performance. Maybe they'll choose a startup company or maybe the normal small company. They'll try to invest on that company with an ambition to improve the performance of that company. Ultimately, they will sell them into the profit and they will realize the cash. These are the normal investment strategies private equity firms follows. So here we will see few strategies. So LBO, the leveraged buyout. Already we discussed what is the leveraged buyout, right? Also, we discussed about case study, the leveraged buyout case study, right? So in this leveraged buyout, again, I will talk about the leveraged buyout. If you are acquiring any company, if you want to acquire any company, we have different methods or different sources of funds to acquire. We can use our own fund, or else we can use the partners fund, or else we can use the loan fund. Loan fund means we'll borrow money from the financial institutions or from the outsiders. That borrowed money will be used to purchase the company. That is called leveraged buyouts. Is everyone understanding? While purchasing company, if you want to purchase any another company, we have a different sources of cash flow to purchase the company. We can use our own savings, we can use the equity part, or else we can use the borrowings part. Suppose majority of the capital, majority of the fund, if you are using from the borrowed money, you are borrowing money just to meet the purchase price. The goal is to increase the company value over a time, and we'll sell it for higher price. So that what is the advantage with this leveraged buyout? Suppose we are borrowing money from the financial institutions, I'll be paying only the interest amount, and also I'll be repaying the principal amount. I don't need to share any profit, right? If I'm going to
Yes.
sell it for a higher price, definitely there will be huge profit. Maybe I can purchase it for 100 lakhs, I can sell it for 200 lakhs, 100% profit. So if I take a partnership, if I take a ownership fund, again I need to distribute the profits. So to avoid the distribution of profits to the shareholders, what I'll do, I'll get a borrow from the financial institutions. I'll use that money to purchase the company. Are you guys understanding?
Yes, sir.
That is called leverage buyout. Leverage. We are leveraging the financial worthiness. Then we have venture capital, VC. We call it a venture capital and VC. The venture capital, already we discussed about this venture capital also. Normally, this venture capital is nothing but investing in a startup at the early stage itself, where the idea has been generated by youngsters or maybe group of people, where it has a high growth potential in the exchange for equity. There we will go and will invest the amount. We know about venture capitalists, VCs. We call it the VCs. So this venture capitalist part is to identify the potential investments at the startup stage, at the early stage itself. They will identify. They will provide a mentorship also. I mean, what kind of research we have to do, what kind of strategies we need to follow to excel this idea, the networking opportunities, campaigns will be running by the venture capitalists, all the advertisements, campaign, everything will be done by the venture capitalists. Basically, they will build the idea to the larger forum so that the brand value will increase and the value of company will also increase. Obviously, they will get a huge, growth will happen. So when they have a huge growth, when they started a small startup, but now investment played a crucial role. So obviously the company growth has been increased. In this case, we will exit from the fund by selling our stake, selling our positions. That is one kind of strategy called venture capitalists. So venture capitalists always will focus on the startup stage, early stage. Okay. Then we have a growth capital. So as a growth capital means normally we have different strategies in the investment also. Suppose if you see the company investments, we have different stages like this. Intro, growth, maturity. Okay, these are the normal stages. Introduction is the where the value is very less and we are just on the process of investment. Growth is where the company is growing a lot. Maturity is the highest value. It reaches to the highest value. Then we call it as a harvest. These are the strategies. We can invest either at the introduction stage, I mean the startup stage, or we can invest at the growth stage, or else we can invest at the maturity stage. Harvest is something but selling of our investment, selling of a company, where the company is the highest peak, where it is about to close or about to uh, shut down their operations or something, that is called harvesting stage. So we can invest either in the introduction stage if you are focusing on introducing investments on the introduction startup stage, that is called venture capital. Growth stage. Growth capital means where the company has already well established. Maybe recently when companies went for the IPO, we can say the companies recently went for IPO and become successful, right? So we'll focus on those kind of companies because they have started from long back and they're performing well. Recently they went for IPO as well. That means they are well established. So we'll identify those companies and we will invest some amount into those kind of capitals, those kind of companies also. Basically, we will identify the established companies, well established companies, and also at the same time where they're looking for the growth. Maybe they're launching for the new capital, new product. They're introducing a new market line. The market expansions. They are trying to acquire new companies. Like that, they're expanding. They're trying for the alternatives of growth. So we'll identify those companies. We'll invest and go. We'll go there and we'll invest there. That is called growth capital. This is also one of the strategies. Are you guys understanding and differentiating between the venture capital, growth capital, and leveraged buyout? For each and every investment strategy, you should be able to differentiate how each strategy is different from the previous strategy. Okay. So private equity firms always will focus on the growth companies or maybe the only well established companies. Then does they don't focus on the weak companies where the companies are going for a bankruptcy, where the companies are having a lot of challenges through operations or maybe the financials. Don't they focus on those kind of companies? They will focus on those kind of companies also. That is called the harvest stage. Harvest means where the companies are suffering and because of financial distress. Maybe they're going for get bankruptcy. If they want to restructure their entire financial system, if they want to restructure their entire company structure in terms of finance and organizational everything operations, that's we call as distressed. So they'll also find out those distressed investments. We call this distressed investments. So distressed investment means investing in a companies where they have a high financial distress, have financial problems due to the bankruptcy or maybe the operation challenges because of failure in any projects or something. If they're facing a lot of challenges, they will identify those companies and they will restructure their companies. Maybe because of high capital expenditure, some companies are suffering a lot of operation challenges. So what they will do, as a private equity funds will focus on those companies. They will restructure the capital. Okay, you have invested this much amount in the capital expenditure. You should not be investing this much in the capital expenditure. That's why we're facing a lot of losses. So what we'll do? Let's restructure this one. We'll change this and we'll restructure this. In that way, we can reduce the financial burden to the companies. Again, we can see the profits on that. So this is called distressing investments. Is everyone understanding this?
Yes, sir.
Yes, fine.
There we have a mezzanine financing because mezzanine. I'm not sure about the exact pronunciation, but it's a mezzanine, I think. Mezzanine finance. Suppose already we discussed one example. This Switzerland industry, right? This is almost similar to the LBO, leveraged buyout. Leveraged buyout is very helpful when you are very sure about the successful project. Because if it is all successful, if you are going to get a huge profits, we can avoid the profit sharing so that we will get huge profits, right? What if you get a loss? The Switzerland went for the LBO to purchase one company, right? To get that manufacturing unit of a windmill. What happened? Because of the
Loss.
crisis, they end up with the losses, right? At that time, they were trying to change the debt to equity. That means they were trying to issue shares for the debt holders who are holding the bonds and debentures. They were asking to convert them into the equity. What they are doing, the parties, suppose I have given some loan, I purchased some debentures or bonds from the company. Now the company is offering equity shares. Instead of giving a repayment of a principal amount, interest amount, what they're doing, they try to convert it into equity. But again, if as a bond holder, as a debenture holder, if you want to convert into equity, definitely the share price should be more high, right? The value should have a higher value for the company. Then only I'll agree. If there is no value for the share capital, then why should I convert my bond to equity? There is no point in conversion, right? So normally as an investor, normal investor, they won't agree for that. So in that case, they will identify those companies. So they will provide a hybrid debt and equity finance to the companies, which involves a high interest rate. They will take the entire finance and they will provide a high interest rate loans to the companies. Laterally, they will convert the debt into equity part. First, they will also offer debt only. By observing the company positions, observing the company potentiality, slightly, if company is moving all good, then slightly they will convert, started converting into the equity part. First, we'll convert some portion of debt to the equity. Later, we'll convert some other portion of debt to equity. Like that, over a period, they will try to convert the entire debt to equity. That's very, what is a safe side strategy, because as long as you are maintaining the debt, you will be getting fixed rate of interest. Suppose if company is performing well, the equity share value is increasing a lot, then we can convert it into equity. But still, some portion of amount will be there in the debt instruments as well. In that way, we can manage the risk as well as the returns. So this is called private equity strategies. Has everyone understood?
Yeah, man.
Then what else we have in the private equities? Yeah.
Mahesh,
Yeah, please go ahead.
you have to tell him once again mezzanine finance.
Sorry?
Mezzanine finance.
Okay,
Repeat once again. One is అన్న అది మెజనాన్ ఫినాన్స్ అనేది రిపీట్ చేయన్న ఒక సింగిల్ వర్డ్ లో కానీ టూ వర్డ్స్ లో అర్థం
Basically, the private equity fund, what they're doing, they're investing amount, right? If it is a private company, if you want to purchase private company, we have different ways. We can purchase the entire loan amount. We can use the entire loan amount. We can purchase. That is one option. We can purchase. We can use the, capital amount to purchase. The ownership fund to purchase the company. That is one strategy. But in this mezzanine, what they're doing, they're using the combination of both debt and equity. They use both the debt capital plus equity capital. Both they will use. But over a period, what they will do, they'll try to convert debt into equity. Suppose if they're continuing the same debt part, they have a disadvantage. What is the disadvantage? They'll be getting fixed rate of interest only. They cannot participate in the profit sharing, right? Are you guys understanding? As long as I'm maintaining a debt, I'll be getting fixed rate of interest. If company is performing well, still I'll get a fixed rate of interest only.
Yes, sir.
What if I convert my debt into equity? Slightly, maybe over a period. First year I'll convert 20% debt. Second year I'll convert 10%, 20%. Like that, I'll keep on converting my debt to equity. By converting this debt to equity, what I can achieve? I can achieve profit sharing, right? I can also participate in the profit sharing of a company. That will be more returns, right? Is everyone understanding?
Yes, sir.
But why can't I invest the entire amount in equity part itself from the day one itself? Why I have to distribute between the debt and equity? I'm saying that as a mezzanine finance, we are diversifying the risk between equity and debt. As a hybrid investment, we're following. Why I need to follow this hybrid? If company is performing well or something, if I know, directly I can put my investment into the equity part directly, right?
Yes, sir.
Because there will be uncertainties. Because of the uncertainties only, without taking a complete risk, what I'm taking, I'll take it as a debt for some portion. I'll take some equity portion in the some other portion. Basically, I'm trying to manage the risk and reward both. Return and risk, both I'll try to manage with this hybrid capital.
Get
But
returns.
over a period, I can observe whether the company capital is increasing or not, the value of capital is increasing or not. If I observe, okay, company value is increasing, then try to convert from debt to equity. If not performing well, At least from the debt part, I'll be safer side. Maybe the equity part may reduce. The value of equity part may reduce. But debt part, I'm safer side, right? Understood now, Lakshman?
Yes, sir.
Whose question that was?
It's me, Mahesh Sharif.
Understood, Sharif?
Yeah,
Are you sure?
yeah.
Okay. So these are the strategies normally we have as the private equity. Okay. Now we will see few more terminology in the private equity. Okay. Yesterday we were talking about commitments, right? What is commitment? Why I have to take commitments? Why I have to take commitments? Hello.
Sir,
Why I have to take commitments?
To return or pay something back uh, for a specific period of time. Like,
Basically, it's a commitment I told you. We need some agreement from the limited partners. Here they are saying like we will pay 50 lakh, 50 lakhs. But what is the guarantee? And also we need to fix the liability as well, right? Some extent. This is your limited liability. For this extent, you are liable for a amount of capital. Like that, we should fix the liability as well, right? That's the reason what I'm doing. I'm fixing the liability in terms of commitments. So commitment is basically amount an investor in a private equity fund has agreed to invest into the fund. So all these partners, TCS agreed 50 lakhs, GPF agreed 50 lakhs, LIC also agreed 50 lakhs. This is called agreed amount. Commitment is nothing but an agreed amount for the investments. So whenever as an investor call, I mean as a private equity general partner calls, they have to pay back that amount to the private equity. They have to provide that amount to the private equity fund. That is called commitment. Just give me a minute. One second. Okay. So yeah, where are we discussing? Commitments. So commitments is basically the agreed amount. As an investors, while they're entering into the fund, they have to agree for some amount of capital, how much they can contribute to the fund. That the agreed capital is called commitments. So whatever the commitments they have given for that amount, they need to liable for the commitments, for the contributions. Okay? Is everyone understanding? Suppose let's
yes,
assume we have a Dinesh. Okay? He agreed for 100 lakhs. For 100 lakhs, he agreed for the commitment. Okay? In the first year, general partner, these are the limited partners. Okay? Limited partner. Let's assume, let's add few more names. General partner, they'll collect money. Okay? Dinesh, we have a Mahesh. Mahesh agreed for 150 lakhs. And we have Dhoni agreed for 200 lakhs. And we have Manoj agreed for 50 lakhs. Okay, let's assume we have a 4 limited partners and we have a general partner as well. Okay. In the first year, maybe that what is the total commitment capital? We can't get it in this way. 100,
500.
300, 500. So 500 lakhs is the total commitment capital. So as a fund, we will be receiving 500 lakhs from the all these investors. Okay, on the first year, let's assume on the first year, okay, in the first year, private equity fund, private fund required 50 lakhs. How much?
50
50
lakhs.
lakhs capital. Maybe in the first year itself, if they want to meet their operational expenses or something, they just need 50 lakhs capital. They don't need the entire 500 lakhs. They just need 50 lakhs capital they need. So from whom they can collect this 50 lakhs?
General part.
This general partner only will be collecting that amount. As a fund, we need 50 lakhs in the year 1. So from whom I can collect this 50 lakhs?
The limited partners నుంచి collect చేయాలి.
From limited partners, right? We have 4 limited partners. We have 4 limited partners. So in this case, from whom I can collect? From whom I can collect? I can collect from anyone. There is no any order. There is no any priority. This 50 lakhs can be collected by general partner from this limited partners in any order. But the maximum extent is their commitment.
Yes, sir.
Suppose let's assume I'm dividing in this with 50 lakhs. I'm dividing like this. From Dinesh, I'll collect 10 lakhs. From Mahesh also 10 lakhs. And from Dhoni, I'll collect 20 lakhs. Again from Manoj, I'll collect 10 lakhs.
10.
Totally, I'll have collected
50 lakhs.
So while collecting this money, how should I collect? Suppose from the day 1, today I'll call them, give me 50 lakhs, give me 10 lakhs. But today itself, we have to deposit 10 lakhs to the private equity fund because you agreed for this 100 lakhs, right? You given a commitment of 100 lakhs. Now I'm asking 10 lakhs. Within a day, you have to give me. Like that, can I ask them?
No.
Before collecting money, I should send out some letters. What kind of letters, sir? That is called a capital calls. What?
Capital.
Capital calls. So capital call is nothing but whenever the fund need money to invest in assets or maybe to pay the expenses of the fund or something, what they will do? They will issue some capital calls to the investors, limited partners. Who will issue these capital calls?
General partner.
General partner will issue these capital calls. To whom?
Limited.
To the limited partners. What is the purpose of issuing these capital calls?
They need
To
investment.
collect money, to collect their commitment capital, to collect the portion of capital. The portion of commitments, the 10 lakhs they need, right, from each one. So for this 10 lakhs, they will issue capital call to the Dinesh. But 20 lakh capital call will be issued to Don. Are you guys understanding?
Yes, sir.
So by issuing the capital calls, they'll collect money from the partners, which is nothing but the portion of our commitment capital will be collected by the general partner by issuing the capital calls.
Okay, sir.
Normally, before 15 days, the capital call notice approximately 15 days time to pay that money to the fund will be given, so that investors will take time and they will pay back amount to the fund. That is called capital calls. What if, sir, maybe suppose initially we have decided like as a fund we need 500 lakhs capital. We need 500 lakhs capital. But fund decided that no, this 500 lakhs capital is not sufficient. We need 700 lakhs capital. We need 700 capital. 700 lakhs capital. More than, in addition, 200 lakhs capital we need to start this investment and all. We have a requirement of that much capital as a fund. So what they will do?
Limited partners ని increase చేయొచ్చు.
So I can allow new investors. But
Yes,
if I
sir.
keep on allowing that kind of investors throughout the period, throughout the 10 years, what will happen? Definitely by observing our fund returns and everything, even these investors also will be coming forward to invest more amount of capital, right? Suppose I have invested 150 lakhs. Maybe after second year, what I'll do? I'll observe and I can see a lot of returns generating by the private equity. So I'll come up with 100 more lakhs. There is a possibility, right? In the second year, third year, I'll come and I'll invest extra 500 crores.
Yes, sir.
So to avoid this exit and entry of some investors, there will be clause for every commitments. There will be clause that is called commitment clause. What we call it as commitment clause. Commitment clause means wherever the fund needs to stop the commitments, they will close the commitments. They will finalize the commitments so that the capital calls will be, the commitments will be closed. They're not going to accept any commitments, new commitments from the investors. Again, as I mentioned, maybe after 1 year or maybe after 6 months, If fund need additional capital, again they will open the close. Again they will allow for the new investors. They'll give a chance for the new investors. That is called second close. This is the first close. After collecting 500 crores, I close this fund. Here I am closing. This is called first close. Additionally, I need how much capital? 200 lakhs capital I need. So after collecting this 200 lakhs capital, again I'm closing the commitment. That is called second close. Maybe after 3 months, I need 100 lakhs capital. Again, I'll collect this 100 lakhs capital. I'll allow new investors. Again, I'll close. That time that is called third close. Is everyone understanding the meaning of close?
Yes, sir.
Everyone?
Yes, sir.
Okay. So as a closing, after finalizing the commitments from the limited partners, general partner as a fund will announce the close. So after this close, no investors, no commitments will be allowed into the fund. That is called first close. First close means when they have collected initial amount of commitments from the capital, from the investors, they'll close it. That is called first close. The subsequent close will be called second close and third close. Is everyone understanding?
Yes, sir.
Okay. Again, let's come back to the same example. We are discussing about capital calls. So they have issued 10 lakhs for the capital lakhs, 10 lakhs, 20 lakhs, and 10 lakhs. Let's assume all these investors paid this amount. All these investors have paid this amount. Whatever the respective capital calls issued for each investor, they have paid that respective amount. So as a Dinesh, after paying this 10 lakhs, how much capital I can collect from the Dinesh?
90 lakhs.
90 lakhs, right? How you guys are saying this 90 lakhs is yet to pay by the investor? Dinesh,
Already 10 lakhs.
10 lakhs already he paid.
10 lakhs is already paid. His liability is total 100 lakhs.
100 lakhs.
Out of 100, already 10 paid. So remaining balance yet to pay
Remaining
is
90 lakhs he was given.
yet to pay, right?
Yes, sir.
So this is called unfunded commitment. What?
Unfunded commitment.
Unfunded commitment. Why it is unfunded commitment? His total commitment is 100 lakhs. What is a funded commitment? That means paid capital 10 lakhs. So this is called funded commitment or called up capital or paid up capital. Sorry, paid up capital, not called up, paid up. Okay. So after paying this 10 lakhs, remaining 90 lakhs is a unfunded commitment. Are you guys understanding?
Yes, sir.
Now tell me what is unfunded commitment for Mahesh? It's 140. What about for
140.
Dhoni? It will be for
190.
180. And it will be for Manoj for
40.
40 lakhs.
This is for the first year. Okay. Let's come back to the second year. Okay. In the second year again. Second year at maybe third year. Let's say third year. They found again some investment opportunities. In this case, they need a capital of 300 lakhs. How much?
300 lakhs.
300 lakhs. So again, they have decided like this. From Dinesh, I'll collect 80 lakhs. Can I collect 80 lakhs from Dinesh? Mahesh?
Yes.
Yes. Then from Mahesh, I can collect 100.
100.
From Dhoni, I'll collect
7.
maybe 50. How much total? It became 230. So maximum how much I can collect from Manoj? Can I collect 50?
సార్ మనోజ్ దగ్గర ఫోన్ దగ్గర నుంచి ఇంకొంచెం తీసుకోండి.
How much I can collect from Manoj?
40 only.
40.
Maximum is 40 only. So in this case, can I collect 50?
No, not possible.
No,
Maximum I
sir.
can collect only from 40. So let's assume I have collected 40 also from Manoj. So total how much it happened? 270. Let's assume from Dhoni we are collecting 80. Okay. So total I have received 300 lakhs. Now again
300
after issuing this capital call again for this capital commitments, for this capital call, again I have to issue the capital calls. Let's assume all these capital calls again paid by the investors. What will be the unfunded commitment again after the second capital call?
Yes, sir. Dinesh is a 10 lakhs.
1 second. Yeah, now tell me. Dinesh, how much?
10 lakhs.
10 lakhs.
40 lakhs.
Mahesh?
Mahesh is 40 lakhs.
40.
Next, Mahesh is a 40.
Dhoni?
Dhoni is
Dhoni
100.
100 lakhs.
100.
Manoj?
0, sir. ఇంకా ఏం
So this is called unfunded
unfunded.
commitment after the second capital close. Okay.
Okay, sir.
Okay, maybe let's assume from the third year or maybe the 7th year. Okay, 7th year. 7th year. They have some profits. As a fund got profits. Profits of 100 lakhs. As a fund got profit of 100 lakhs. Now they want to distribute this profit to these persons. How they will distribute?
వాళ్ళు ఇన్వెస్ట్ చేసిన దాని ప్రకారం
As per
డిస్ట్రిబ్యూట్
the, I mean, as a profit, as a whole profit, we are still in the 7th year, maybe 8th year, 9th year, 10th year, we will get a few more profits. But normally the profits will be distributed as per their capital ratios, investment ratios. So each
Yes,
have
sir.
contributed this much capital, right? As per this ratio, the amount of capital will be distributed among the investors. Okay, let's assume this 100 lakh capital, 100 lakhs capital, where they're distributing in this way. They're distributing like this: 30 lakhs. Here they will distribute 30. Here also they will distribute 30. For Manoj, they will distribute only 10 lakhs. In this way, they have distributed 100 lakhs capital. Okay. After distributing this, how much amount will be there as an unfunded commitment? They have distributed some profits. They have distributed profit. These are the distributions. Distributions. Even for the distributions also, they will give you some notice. For what purpose we are giving the distributions? Distribution means we have two ways. One is we can distribute the profits. Another one is we can distribute the.
Funds.
1 second. Yeah. So we can distribute the profits, or we can distribute the capital. They have invested this amount capital, right? We can invest this. We can return back the capital also. We can distribute the capital as well. It can be any kind of distribution. Again, distributions we have a lot of ways. We'll talk about it. But for the namesake, we're talking that they can distribute the profits. We can distribute the capital also. For here in this example, we are talking about the profits. They're distributing the profits. Okay. So after distributing the profits, what would be the unfunded commitment?
40.
So basically, you're trying to add this distributions also to this capital unfunded commitment.
Yes, sir.
We cannot
130.
add. We cannot add. Okay.
సార్ అగ్రిమెంట్ ఉంటుంది కదా సార్ 10 years కి.
Let me explain. Let me talk. So we have unfunded commitment, right?
Yes,
Unfunded commitment won't be having any impact because of the normal distributions. These are normal distributions. Normal as in without saying anything, I'm just distributing the capital, or it may be the profits, whatever it is. I'm not stating anything. So I'm distributing. So there won't be changes in the unfunded commitment. But if I say here I'm distributing 30 lakhs, right? Here I'm distributing 30 lakhs. So while distributing, what I'll tell, here I'm giving 30 lakhs. Out of this 30 lakhs, 20 lakh is the recallable distribution. What I'm mentioning? Recallable. So I'll mention 20 lakhs is a recallable distribution. For him also I'll mention 5 lakhs is recallable. What is the meaning of recallable? As
అంటే
a,
that amount they will again invest in.
yeah.
Again,
So as a commitment, you don't need to pay more than 100 lakhs. As a commitment, 100 lakhs we given. As per the limited liability, I mean LPA limited partnership agreement, you don't need to pay more than 100 lakhs. Even I have a right to collect it from the only this 10 lakhs balance, because already you paid 90, here you paid 80, right? Sorry, 10 plus 80, totally you paid 90. So I have a right to collect from the Mahesh, Dinesh up to only 10 lakhs. Okay, but I'm distributing some profits. What I'm mentioning, I may recall this capital. I may recall this capital again later also. That point, if I'm mentioning in the distribution notice, I told you, right? While distributing the profits also, I'll give you the notices. I'll give you the notice. So while giving the notice, what I'm mentioning, out of this 30 lakhs, 20 lakhs again I can recall. Whenever I need capital, I'll recall. Similarly, for the Mahesh, Dhoni and Manoj also I mentioned some capital amount. This much capital again I'll recall. Whenever I need capital, I can recall. So in this case, what would be the unfunded commitment?
10.
Already they have unfunded 10 lakhs. I'm giving a distribution 30. Out of 30, again 20 is recallable. Again, I can call back 20 also.
Yes, sir.
So what would be the unfunded commitment in this case?
30.
30 lakhs. So
Yes.
unfunded commitment is basically unfunded capital plus recallable distribution. All together will be considered for the unfunded commitment. But if there is any unfunded commitment, in that case only it will work. Sorry, in there is a recallable distribution, then only it needs to be added to the unfunded commitment. Whenever there is a recallable distribution, then unfunded commitment will impact. If there is no recallable distribution, then there won't be any impact in the unfunded commitment. Understanding,
Okay.
guys?
Okay, sir.
Is everyone understanding the meaning
Yes,
of
sir.
unfunded and recallable?
Yes, sir.
Recallable means while distributing profits or maybe the capital to the investors, again they have a right to call back the capital. Whatever the amount they have mentioned as a recallable, out of that recallable amount, they can call back from the investors. It will impact the unfunded commitment of limited partners again. Understood, everyone? Hello?
Yes, sir.
Everyone understood, guys?
Yes, sir.
Yes, sir.
So this is basically the
Yes, ma'am.
commitments related. So we discussed the commitments, unfunded commitment, capital calls, distribution calls, and recallable amount, how it is impact on the unfunded commitment. Okay. So I'll stop the recording here. And also we discuss about the closing. What is commitment? What is the first close, second close, and all. So tomorrow I'll talk about the distributions. And the distributions. What are the types of distributions we have? Types of distributions we have. Okay. Thereafter, we'll talk about the management fee calculations, the performance fee, and that's it. Performance fee. Then finally, we'll discuss about the few more concepts. We have hurdle rate, how the performance will be charged, all these concepts, and finally, the distribution method. We have a distribution models actually for the capital distribution. Also, they cannot distribute in the way however they want. Depends on the several parameters. We need to distribute this amount to the investors. So we'll talk about this distribution models as well. Waterfall distribution we have. We'll talk about it so that we can wind up the private equity. Again, guys, I'm talking about all these commitments, capital call distributions, unfunded commitment, recallable distributions. All these concepts are not only applicable for the private equity. The same concepts will be there in the hedge funds also. Whatever the concepts we are discussing now, it's a combination of hedge funds plus private equity. But in hedge funds, few extra strategies will be there. Few like 4 or 5 points will be extra in the hedge funds. So we'll also cover those points so that we can wind up the sessions. That's the reason you should be very much good with the concepts of fund accounting. Very simple. When you compare with the investment banking, fund accounting concepts is very limited and very easy. I hope you guys are understanding the concepts of private equity and fund accounting.
Yes, sir.
Is everyone understanding? Is everyone understanding, guys?
Yes, sir.
Let me stop the recording.